Now, we still have a liquidity issue in this particular estate because the business would probably constitute a greater than 50% portion of the trust assets in the charitable trust. Now, what do? Well, we don't just, we would have to buy that particular business back. We have a plan for liquidity is a very important part of estate planning, and that's the last part I want to touch on with you. There are 3 ways to pay for any liquidity need, whether it's paying for taxes, whether it's funding a particular buyout necessary within the family assets because of the nature of the family. But the 3 techniques of liquidity are to use existing capital, to borrow capital, or try to obtain some sort of leverage created capital. I'm going to look for a second at using assets themselves if they have to be sold off and liquidated. If we don't have enough cash, even if we do, it drains all of the cash out of the estate. We have basically 9 to 15 months to come up with liquidity needs on an estate. If it's dealing with federal estate taxes or with federal income taxes, we have a very limited amount of time to sell very large assets. We have to sell them quickly, and the result is a lot of times people are forced to sell assets for less than 100 cents on the dollar. A lot of times they incurred losses just because they had to sell the asset at a discount, and the average is probably about a 33% discount. That means you'd have to sell 150,000 assets to come up with $100,000 to pay a $100,000 need. So what we're ending up with is spending a lot more and incurring even more losses to pay whatever particular expense there is when the estate holder dies. The second option is to borrow the money, but you got to pay back principal and interest. There are some federal programs for paying federal estate taxes on the installment plan under Section 6166 and 6166A, but they're limited. They're limited just to those portion of the estate that consists of business assets. Business includes a farm. And it's also limited. The interest rate's only 3%, but it's limited on how much that can be borrowed. At 3%, the payback is 15 years on that you can use to pay back those taxes. The rate of return, the total rate of return would be about $1.83 for every dollar of tax that you owed by the time you got finished paying that interest in addition to the principal. If you borrowed money in the marketplace at 10%, you're going to end up paying back about $2.53 for every dollar that you owed. A last option for people when they can reduce down what their liquidity needs at death are to a dollar amount is to look at life insurance, death benefit. And the great thing about life insurance, instead of paying interest on top of the principal, you're setting money aside in advance. It can be set into a cash value where it earns principal. And you're looking for $100,000, so you're going to set aside enough money. And the insurance company does mortality tables. They have mortality tables that tells them about how long you're going to live and how long they accumulate money at interest. So they don't have to collect the whole $100,000. They just collect what that $100,000 would discount down to if they subtracted out the interest earnings. And the result is that the difference, a lot of times you'll pay 5, 10, 15 cents on the dollar for life insurance total premium, maybe even as much as 20 cents by the time you're in your 60s. And the rest of that dollar, that other 75, 80, 90 cents is made up in interest, compound interest. And the result is that it's a great way to reduce the actual out-of-pocket costs. And as a result, if a person has cash or they have some liquid or semi-liquid assets, one alternative is to think about taking some of that, moving it into a life insurance policy that'll sustain the amount that they need for the liquidity need. And usually within 12 months of the premium being paid, the amount that they put into the policy will be sitting in cash value in the policy, so they really haven't lost the money, they just reallocated it to a different type of investment pool. So when it comes to estate planning and figuring out how to pay costs and come up with different types of liquidity, one answer that every client ought to consider is life insurance as a possibility. And then an agent will have many, many different ways to plan that life insurance, both the cost and premium and the use of the death benefit. So to end here, we're suggesting that the data, our data gathering form that is available on our website at www.fosterestateplanning.com, that you complete that with the information on your estate and submit it. And what we will do is we will calculate all these different techniques and come back with an organized plan showing you what your expenses will be based upon the data that you've submitted if you were to die right now. And we'll also show you what those expenses will look like in a 10-year projection. And then we'll also give you a picture of what can be done. We'll at least show you what that number can be reduced down to. And if you wish, we'll be happy to provide you with a full narrative and video explaining how to get from the high expenses you might currently be incurring down to zeroing out those expenses through some of our planning techniques. So we would encourage you to click on that, go into that website and click on that data gathering form. Download it. It's an Excel form. Fill it out the best you can with information. If you don't want to give us all your private information like names or social security numbers, fill them in with blanks or make information up. But if you give us your accurate data inventory, we're going to need that to come back with some accurate recommendations and to come back with some accurate calculations on just how big is the problem that you're currently facing. So what we would encourage you to do is to go into the website and click on that and download it, complete it, and then email it back to Foster Estate Planning when you have it completed. Thank you.